Here's a question we hear all the time. What is a 1031? How does that work? Thanks to Internal Revenue Code Section 1031, a properly structured 1031 exchange allows an investor to sell a property, to reinvest the proceeds into a new property, and to defer all capital gain taxes on that sale. It is one of the most powerful wealth-building tools available to real estate investors and a strategy that we spend a significant portion of our time working on. So why is this so powerful? Consider the following example. Assume you have $500,000 in gain and also $500,000 in net proceeds after closing on an investment property that you own. Assuming you have a $500,000 capital gain and incur a tax liability of approximately $175,000 in combined taxes, when the property is sold, only $325,000 of your net equity remains to invest in another property. Now, assuming you put a 25% down payment and take on new financing for the purchase with a 75% loan-to-value ratio, you would only be able to purchase a $1.3 million replacement property. But if you chose to perform an exchange, however, you would be able to reinvest the entire gross equity of $500,000 into the purchase of a $2 million replacement property, assuming the same down payment and loan-to-value ratios. So this allows you to grow your portfolio size by over 50% of what it otherwise would have been after paying capital gains and recapture taxes. So how exactly does it work? Well, language straight from IRC 1031A1 says, no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment of such real property, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade or business or for investment. So this is accomplished by using a qualified intermediary, or QI, which is a third-party entity that temporarily holds a real estate investor's relinquished or replacement property and the proceeds that come from it. The QI then ensures that the proceeds from the sale of a relinquished property are made available to the investor at closing on the replacement property. In this way, the investor never takes possession of the sale proceeds of the property, thus qualifying him or her for deferral of capital gains and depreciation recapture taxes. So there are other rules that must be followed as well to have a valid exchange. One relates to timelines. From the time an existing or relinquished property is sold, you as an investor have 45 days from that closing to identify your possible replacement properties. Then, within 180 days of the closing of the relinquished property, or 135 days after your identification period, you must place the deferred proceeds into a replacement property that you close on. So how much does it cost? Fees vary based on the QI you use, but can range from as low as $600 for a basic transaction to $10,000 or higher for more complicated transactions. How long do you have to hold a property for it to be eligible for an exchange? While there isn't an explicit requirement from the IRS in this regard, most accountants recommend that a property is held for 2 years, or at least 2 separate tax filing periods before entering into an exchange. While 1031s are a popular and effective tax mitigation strategy, they are not a solution for everyone. There are many instances where a 1031 either is not permissible or not advisable for investors. Working with experienced advisors can help you to identify in which situations they make sense and when they don't. As always, Sterling CRE does not provide tax, legal, or accounting advice. You should talk to your tax attorney and accountant for advice related to your specific situation. It's crucial that your team of advisors has comprehensive knowledge of the exchange process and 1031 code. If deferral of capital gains might fit your investment strategy, you're invited to contact Sterling Commercial Real Estate Advisors. In concert with your tax and accounting advisors, we help investors like you dispose of depreciated assets and replace them with investments which might have a higher basis. We can help investors find properties that fit their stage of life better, moving from high-maintenance apartment projects, for example, into single-tenant net lease investments that provide low-stress mailbox money. In a future episode of How Does That Work, we'll dig in deeper to the 1031 exchange and explore some additional gotchas and more advanced strategies for making this tool work for you and your family. Thanks for watching.